Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.19 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we're going to cover three main ideas. What broker selection actually means when you run a computer program that trades for you. Why the right broker is a make-or-break factor for any automated strategy, and a quick preview of the steps you will need to check before you hit the live button. By the end of this video, you will understand how to pick a broker that will let your bot breathe, execute trades quickly, and keep your risk rules intact. Think of it like choosing a delivery service for a pizza you ordered online. You need a place that can get the pizza hot, on time, and exactly the size you asked for, otherwise the whole dinner falls apart. In the same way, a broker provides the kitchen, the delivery truck, and the rules about how many slices you can order. If any part of that chain is weak, your automated trading plan will suffer. So grab a notebook, because we'll walk through each piece step by step, using a real-world euro to US dollar robot as our example. Let's get into it. Now let's dig into what broker selection actually means for automation. A broker is simply the company that gives you access to the foreign exchange market, like a bridge between your computer and the banks that set the prices. When you run a trading bot, the bot talks to the broker through something called an API, which stands for Application Programming Interface. Think of it as a set of doors and hallways that let your program send and receive messages. If the API doors are narrow or locked, your bot can't move fast enough. That brings us to latency, which is the time it takes for a message to travel from your bot to the broker and back. Imagine you're ordering a coffee and the barista takes 10 seconds to hear your order. That delay can mean you get a cold drink. In trading, a few milliseconds of latency can turn a winning trade into a loss. Execution type is another piece of the puzzle. It tells you whether the broker will fill your order instantly at the price you asked for, called market execution, or try to get a better price first, called limit execution. Finally, the broker's rules about how many lots you can trade, what margin you need, and how often you can call the API are like the restaurant's menu limits. You can't order a steak if the kitchen only serves salads. Understanding each of these pieces helps you pick a broker that lets your bot act like a well-trained courier, delivering orders quickly and exactly as you intended. So why does the broker you choose matter so much for an automated trader? The answer lies in how your bot manages risk, places stop-loss orders, and sizes each position. A stop-loss is a safety net that tells the broker to close a trade if the price moves against you by a certain amount. Think of it as a fire alarm that shuts the furnace before the house burns down. If your broker has high latency, the alarm signal can arrive late, and the price may have moved further than you expected, causing a bigger loss. That extra movement is called slippage, and it can turn a 10-pip stop-loss into a 30-pip loss in a worst-case scenario. Next, consider position sizing, the amount of money you risk on each trade. Brokers often set a minimum lot size, which is the smallest chunk of a currency you can buy or sell. If the minimum is larger than what your strategy wants, you either have to over-risk or abandon the trade. For example, a robot that wants to trade 0.02 lots on euro to US dollar may be blocked by a broker that only allows 0.1 lots, forcing you to risk 5 times more capital per trade. Finally, margin rules determine how much of your account balance is held as collateral for an open trade. A broker with tight margin requirements can force a liquidation if the market moves a little, cutting your bot short before it can recover. By looking at a quick checklist, API access, latency, slippage policy, minimum lot size, and margin rules, you can match a broker to your bot's needs, keeping stop losses effective, position sizes accurate, and overall risk under control. All right, looters, let's walk through a real-world scenario that shows exactly how a broker choice can make or break your euro to US dollar robot. Imagine you have built a simple bot that buys euro to US dollar whenever the price drops below 1.0800 and sells when it climbs above 1.0900. The bot runs 24/5, placing a trade every few minutes. Now you need a broker, the platform that actually executes those trades for you. Think of a broker like a delivery service for a package. You want one that's fast, reliable, and doesn't add unexpected fees. Let's compare two fictional brokers. Broker A offers a free API, meaning your code can talk directly to the broker's system without extra steps, and it advertises an average latency of 30 milliseconds. That's like a courier delivering a letter in the time it takes to blink. Their spread on euro to US dollar is 1.0 pip, which is the difference between the buying and selling price, and they allow a minimum lot size of 0.01, the smallest piece of a standard contract. Broker B also offers an API, but it's a paid add-on, and their latency averages 150 milliseconds, a noticeable delay that can turn a winning trade into a loss when the market moves quickly. Their spread is 2.5 pips, twice as wide, and they require a minimum lot of 0.1, meaning you need 10 times more capital to open the same position. If your bot is designed for tight spreads and small lots, Broker A aligns perfectly, while Broker B would eat into your profit and limit your ability to scale. This example shows why you must match the broker's technical specs and cost structure to the specific needs of your automated strategy before you even place a single trade. Now that we have a broker shortlist, the first technical step is to verify API access and latency. API stands for Application Programming Interface. Think of it as a special door that lets your trading robot talk directly to the broker's computer system, sending orders and receiving confirmations without you having to click a button. Not every broker opens this door for free, and some only allow limited commands. So you need to check the broker's documentation or support page for a REST API or Fix API offering. Once you confirm the door exists, the next question is how fast it opens and closes. That's latency, measured in milliseconds or thousandths of a second. In the Forex world, a delay of even 100 milliseconds can be the difference between buying at 1.0800 and getting filled at 1.0803, which can wipe out a small profit. To test latency, you can use a simple ping tool or a small script that sends a dummy order request and records the time until the broker sends back an acknowledgement. For example, you might run a test that sends a heartbeat request every second and logs the round-trip time. If the average comes back at 30 to 50 milliseconds, you have a fast connection suitable for high-frequency bots. If the numbers bounce around 150 to 200 milliseconds, you may need to look for a broker with servers closer to your location or consider a different hosting solution. Remember, a reliable API with low latency is the foundation for any automated strategy, because without it, your robot's decisions are always a step behind the market. Step 2 dives into how the broker actually fills the orders your bot sends, the called execution type, and what happens when the market moves between the moment you request a trade and the moment it gets filled, known as slippage. The most common execution types are market orders and limit orders. A market order is like shouting "buy now" to a cashier. The broker will fill it at the best available price right away, but that price can shift a few pips in fast markets. A limit order, on the other hand, is like leaving a note that says buy only if the price drops to 1.0840. The broker will only fill the trade when the market reaches that exact level, protecting you from paying more, but there's a risk the price never gets there, leaving the trade unfilled. Slippage occurs most often with market orders. Imagine your bot sees euro to US dollar at 1.0840 and send a market buy. By the time the order reaches the broker server, the price might have moved to 1.0837. That's a 3-pip slippage, which can erode profit, especially on tight margin strategies. Brokers differ in how they handle slippage. Some guarantee no slippage on certain account types, while others disclose an average slippage figure in their terms. To evaluate, look at the broker's policy page for statements like average slippage under 1 pip for major pairs, or ask their support for real-world data. You can also run a small backtest, place a series of market orders on a demo account during volatile periods, and record the difference between requested and filled prices. If you consistently see slippage larger than 2 pips, you may need to switch to a broker with better execution speed or use limit orders where appropriate. Understanding execution type and slippage policy ensures your automated strategy's assumptions match reality, preventing unexpected losses. Now we move on to step 3. Reviewing the broker's minimum lot size and margin rules. Imagine you're buying a slice of pizza. The smallest slice the shop sells is 1/8 of the whole pie. In Forex, that slice is called a lot. A standard lot equals 100,000 units of currency, but many brokers let you trade as small as 0.01 of the standard lot, which is called a micro lot, or even 0.001, a nanolot. If your automated robot wants to open a position of 0.005 lots, you need a broker that allows that tiny size. Otherwise, the trade will be rejected. Margin is the amount of money you must keep in your account to hold a trade, kind of like a security deposit when you rent a car. Brokers express margin as a percentage or a leverage ratio, such as 2% margin or 50-to-1 leverage. With 2% margin, for every $2 you put down, you can control $100 of currency. If your bot tries to open a $10,000 position on euro to US dollar, the broker will require $200 in margin. If your account balance is only $150, the trade will be blocked. Why does this matter for automation? Your code will calculate position size based on risk rules, but if the broker's minimum lot size is larger than what your algorithm wants, you'll end up with either oversized risk or a failed order. Likewise, if the margin requirement is higher than your account can support, the broker will automatically reject the trade, causing your bot to miss opportunities or, worse, to over-leverage and trigger a margin call. Always check the broker's lot size limits and margin policy before you let your robot run live. This simple check keeps your bot's math aligned with the broker's rules, preventing costly rejections and protecting your capital. Step 4 is one of the safest habits you can develop. Always test your automated strategy on a demo account first. Think of a demo account like a flight simulator for pilots. Before you take a real airplane into the sky, you practice in a virtual cockpit where mistakes cost nothing but valuable learning. In Forex, a demo account gives you virtual money that mirrors real market prices, allowing your robot to execute trades exactly as it would with real cash, but without any financial risk. Let's walk through a concrete example. Suppose your euro to US dollar bot is programmed to buy when the price crosses above the 20-period moving average and is set a stop loss 30 pips below the entry. You upload the code to a broker's demo platform and watch it run for a week. During that time, the bot opens 10 trades, 3 of which hit the stop loss and 7 that close in profit. The demo report shows an overall profit of $150 on a virtual balance of $1,000, a 15% return. You also notice that on 2 occasions the bot attempted to place a trade, but received a rejected due to insufficient margin message. That insight tells you to adjust your position sizing rule before you risk real money. Testing on a demo also reveals practical issues like order execution speed, slippage, and how the broker's platform handles your API calls. If you see that the bot's orders are consistently delayed by a few seconds, you may need to tweak the code or consider a broker with lower latency. By the end of the demo phase, you should have a clear picture of profitability, drawdowns, and any technical hiccups. Only after the demo results meet your expectations should you transition to a live account, and even then, start with a very small capital allocation. This disciplined approach protects your savings and builds confidence in your automated system. One of the most common beginner mistakes when moving to automated trading is ignoring the broker's API limits. API stands for Application Programming Interface, which is simply a set of rules that lets your trading robot talk to the broker's computer system. Think of it like a telephone line. You can only make a certain number of calls per minute before the line gets busy. Brokers set limits on how many requests your software can send in a given time frame, often measured in requests per second or per minute, to protect their servers from overload. Imagine you have built a fast-acting euro to US dollar scalping bot that tries to send 200 trade requests every second during high volatility. Your broker, however, allows only 100 requests per second. When the bot exceeds that limit, the broker server starts rejecting the extra requests, returning error messages like rate limit exceeded. Your robot may interpret these errors as failed trades and either stop trading or, worse, keep trying and flood the server, causing your account to be temporarily blocked or even suspended. The consequences are serious. Missed trade signals mean lost profit opportunities, and repeated rejections can skew your performance statistics, making your bot appear less reliable than it truly is. Moreover, If your stop-loss orders are delayed because of throttling, you could end up with larger losses than your risk management rules intended. To avoid this pitfall, always check the broker's API documentation for rate limits, maximum order size per request, and any cooldown periods. Then, program your bot to respect those limits by adding pauses, batching requests, or using a queue system. You can also monitor the API response codes in real time and log any rejections, so you know exactly when the limit was hit. By staying within the broker's API boundaries, you ensure smoother execution, accurate risk control, and a healthier relationship with your broker's platform. Now let's talk about how a poor broker choice can actually hurt your risk management, even if you have a solid plan on paper. Risk management is simply the set of rules you use to protect your money, like deciding how much you're willing to lose on each trade and setting a stop-loss order to automatically close a losing position. Think of it like a safety net under a tightrope walker. The net only works if it's strong and placed correctly. When you pick a broker, you're also choosing the quality of that net. Imagine you have an automated euro to US dollar bot that watches the market and places a stop-loss at 1.1180 whenever the price moves against you. If your broker servers are slow, there's a delay, called latency, between the moment your bot sends the stop-loss order and the moment the broker actually executes it. In fast-moving markets, that delay can be a few seconds, and during that time, the price might keep falling. The result is slippage. The order fills at a worse price, say 1.1165, instead of the intended 1.1180. That extra 15 pips of loss directly attacks your risk management because you thought you were risking only 20 pips, but you actually lost 35. Some brokers also have a slippage policy that automatically widens the execution price during volatile periods, further eroding your safety net. In the worst case, your stop loss never triggers at all, and your position keeps running until you manually intervene, potentially wiping out a large portion of your account. So, a broker with high latency, poor execution speed, or unfavorable slippage rules can turn a well-designed risk plan into a leaky bucket, letting losses seep through. That's why evaluating a broker's technical performance is as crucial as looking at fees or regulation when you're automating trades. Next, let's link broker selection directly to two core components of any trade: the stop loss and position sizing. A stop loss, as we just discussed, is an order that tells your broker to close a trade once the price reaches a certain level, protecting you from larger losses. Position sizing is the calculation of how many lots or units of currency you should trade based on how much of your account you're willing to risk. Imagine you have $10,000 in your account and you decide to risk 1% or $100 on each trade. If your stop loss is 20 pips away, you would calculate the lot size so that a 20-pip move equals $100. In a perfect world, you could simply divide $100 by the pip value and know exactly how many lots to trade. However, the broker you choose can change that math. First, latency. If the broker's servers are slow, the stop loss might be hit later than expected, turning a 20-pip stop into a 30-pip loss. That means you need to trade a smaller lot to stay within your $100 risk, or you accept a bigger loss. Second, slippage. Some brokers add a few pips to the execution price during volatile moments. If the broker adds 2 pips of slippage, your effective stop loss becomes 22 pips, again altering the risk per trade. Third, the broker's minimum lot size. Say the broker only allows you to trade in increments of 0.01 lots. If the precise lot size you need to risk $100 is 0.008 lots, you're forced to round up to 0.01, which would risk $125 instead of $100. Conversely, if the minimum is larger, you might not be able to trade the strategy at all. All these broker features directly affect how you set your stop-loss level and how many lots you can safely trade. Choosing a broker with low latency, minimal slippage, and flexible lot sizing lets your risk calculations stay accurate, keeping your trading plan intact. If the broker's constraints force you to adjust your stop-loss or position size, you either accept higher risk or have to redesign the strategy. That is why aligning broker capabilities with your stop-loss and position sizing rules is essential for a reliable automated system. Finally, let's give you a quick, practical checklist you can use today to evaluate any broker before you hook up your automated strategy. Grab a pen or open a notes app and work through these 8 points one by one. 1. API access. Does the broker offer a stable programming interface like a REST or WebSocket API that your bot can connect to? Without an API, your bot can't send orders automatically. 2. Latency. Measure the average round-trip time between your computer and the broker's server. Ideally, you want under 100 milliseconds. Anything higher adds delay and can cause missed stop losses. 3. Execution type and slippage policy. Does the broker use market execution, ECN, or a mix? Check how they handle slippage. Do they guarantee execution at the requested price, or do they allow a few pips of deviation? 4. Minimum lot size. Some brokers only let you trade in 0.01 lot increments, while others go down to 0.001. Make sure the minimum lot matches the size your risk calculation requires. 5. Margin and leverage. Look at the margin requirement for a standard euro to US dollar lot and the maximum leverage they offer. Too low leverage might limit your position size. Too high can increase risk. 6. Demo account. Is there a free demo environment where you can run your bot with real-time data but no real money? Always test here first to catch bugs. 7. Support. Do they provide 24/7 technical support, preferably with a live chat or ticket system? When something breaks, you need quick help. 8. Fees. Examine both the spread, the difference between bid and ask, on euro to US dollar, and any per lot commission. High fees eat into profit, especially for high-frequency bots. As you go through each item, mark it green if the broker meets the criterion, red if it falls short. If you end up with more reds than greens, keep looking. This checklist turns a vague feeling about a broker into a concrete, repeatable process, ensuring you pick a partner that supports your automation, protects your risk, and lets you focus on refining your strategy instead of fighting technical issues. And just like that, we've reached the finish line of Lesson 11.19, choosing a broker for automated trading. Let's take a quick breath and recap what we've covered, because a solid summary is the best way to lock in what you've learned. First, we explained that broker selection isn't just about low spreads. It's the foundation that determines whether your automated strategy can actually run, how fast it can react, and whether your risk controls stay intact. We walked through a real-world example with a euro to US dollar bot, showing how a broker's API latency can turn a perfectly timed entry into a missed opportunity if the connection is sluggish. Next, we broke down the 4 practical steps you need to follow. Verify that the broker offers a reliable API and measure the round-trip delay. Check the execution type, whether trades are filled instantly or with slippage, and understand the broker's policy on that slippage. Then we reviewed the minimum lot size and margin requirements, because a bot that wants to trade micro lots will fail on a platform that only allows standard lots. Finally, we emphasize the importance of testing everything on a demo account before committing real money, because a demo lets you see how the broker's order handling behaves under live market conditions without risking capital. We also highlighted a common beginner mistake, ignoring the broker's API limits, which can cause your bot to be throttled or even blocked, leading to missed stop losses and uncontrolled risk. To make it easy, we gave you a quick checklist you can copy and paste into a spreadsheet today, so you can evaluate any broker in minutes. Remember, the right broker keeps your automated strategy fast, reliable, and safe, while the wrong one can sabotage your risk management and erode profits. That is everything for Lesson 11.19, choosing a broker for automated trading. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.